Hello and welcome to Weekend Investing Daily Bytes. Today is 17th of January and we are shooting episode 165. We're going to calculate how to do rolling return calculation and see them on the chart. So it's an elementary process that we want to show. So it's good for new investors or people who are new to this. And we'll also share a spreadsheet on which you can try your hand and do this based on the index returns of several of our strategies and the indices. So let's jump into the markets today, how the markets were doing. So market was reasonably flat all through the day. There was not much action, and I think with results seasons having started full steam and the market having run up almost 2000 points in the last 2, 3, 4 weeks, the budget less than 2 weeks away, markets may try to consolidate at the current levels and not go too far up or down, but that's just a guess that I have. In terms of the sectors, FMCG stayed weak, as it has been relatively weak for the last 3 months. It has the worst performing sector out of the few that we track, along with consumption stocks. Pharma has been weak, and IT, although was up today, but overall in the last 3 months it has not gained. Autos have started to look up. Today it was down 0.4%, but was up 1.5% for the week and 5.9% for the month, 8.6% for 3 months. So autos actually has been the best performing sector in the last 3 months. Other than that, real estate, public sector enterprises, IT, infra and energy were the ones which were having a slightly positive stand today. As we are seeing in the broader indices, the small caps, mid caps, Nifty Next 50, they were all up between 0.25% and 0.5%. So nothing really out of the world there. In terms of weekend investing small cases, MI25, MI80H, MI all cap doing very well. MI35, MI20, MI50 also outperforming. And then LTC NX 200 was a bit soft today. Overall, the last month or so, reasonably good gains across most of the strategies. So the best part about most of these strategies are they are very focused strategies, and because they are focusing on one sub-segment of the market or one type of investing, you can easily plug and play and make a bouquet of several strategies as per your existing requirements of what your financial planner may advise you, that you plug in a part of your funds into small cap stocks, or if you want to do a all cap type of a thing, or if you want to go across, let's say CNX 200 stocks and have some asset allocation, you can go for EverGreen. So several different options are available to you to mix and match along with your existing holdings and portfolios. So we're going to talk about rolling returns, what are them, and how do we calculate them. And you would have seen this in many of our videos. We keep talking about rolling returns, but a lot of feedback came that we don't understand what is rolling returns. So rolling returns is nothing but total absolute returns achieved during a particular period of time, rolled into a continuous time frame. So to simplify this, basically if you are looking at 2 years period, what is the total returns over this 2 year period versus the next 2 year period, the next 2 year period, so on and so forth. So this can be done in two ways. You can look at absolute rolling returns. So if you are seeing rolling returns over a 5 year period, so absolute gains over those 5 year period can be called rolling returns. Or you can also do a CAGR over these 5 years and see the CAGR returns, rolling returns. For that, we are today looking at only absolute rolling returns here. So just to more simplify this example, we have data for, let's say, the index for 10 years. And you can see if it's a 1 year rolling return, which is usually the yearly return that we say. So index going from 100 to 120, the return is 20%. Index going from 120 to 135, return is 13%. So this is 1 year returns, and you can also call it a 1 year absolute rolling return. So this is the returns each year based on where we closed last year and where we're closing this year. So each year is where we are basically concentrating on here. The next can be, absolute rolling return for 2 years together. So 2010 to 2012, going from 100 to 135, you got 35% rolling returns absolute for these 2 years. Then 11 to 13, for instance, went from 120 to 135 back to 120. So, 0% rolling returns absolute for these 2 years. Another going from 135 to 185 in the next 2 years, 37% rolling absolute returns for 2 years. Similarly, for 3 years, going from 100 to 120 over 3 years, 20% absolute returns. Going from 120 to 185 over 3 years, 54% returns, so on and so forth. So what you can see here, and similarly, we have for 5-year rolling returns also. So going 2010 to 2015, 100 to 220, 5-year rolling returns absolute is 120%. Next 5-year return rolling period is 125%. So what you're seeing is that when you're looking at 1-year rolling returns, you are seeing a huge amount of volatility in yearly returns. So 1 year is plus 20, 1 year is plus 13, next year is minus 11, next year is plus 54. So what usually people do is that, they will look at the markets in a very good year and think that, this kind of returns can come every year. And then they get disappointed when it doesn't happen. So if you, came in after 2014, looking at 54% returns, the next year was 19, the next year was 23, the next year was minus 13. You never saw 54 again. So that can be a very disappointing thing and a wrong way of sort of trying to evaluate the strategy that you want to go with. 2-year returns is more smoother. Like you can see here that there is no negative returns. So you can come with a mindset that in any 2-year period, at least I may not see a negative period. 3-year returns, you're seeing that all returns are in double digits at least. So you can come in any year assuming that, in any 3-year period, at least I may get double-digit absolute returns. And 5-year returns, you are seeing here that minimum here was 74% in any 5-year period. So that will build an expectation even at the minimum of these 5 values that we have, that, somewhere high double-digit returns is what I'm expecting over a 5-year period. So this is the kind of sort of, the rolling returns sets your expectation right. As you go farther and farther out in rolling returns, you will find that your expectations setting will be more and more closer to what you may get in actuality. Let's take a look at on the Excel sheet. So we are providing this Excel sheet, and this is already there in the Weekend Investing Hub as well, where you have 4 of our strategies: MI NNF10, MI20, MI35, and MI EverGreen, along with their respective benchmarks. And you can see that, the kind of rolling returns that we have here. So the way to calculate rolling returns is very simple. You take the index if you want to do, let's say, 3-year rolling return, and you're starting from 16, so then you go to 2019 and take the difference of the index returns from 2016 and divide it by the index returns of 16. So percentage gain, absolute percentage gain of over these 3 years, you will get that. These we have already calculated for you, rolling returns over, let me see, this is 3-year rolling returns we already calculated. So you can see here these are 3-year rolling returns for NNF10, 3-year rolling returns for MI20, MI35, and MI EverGreen returns the similar way. So coming back to the charts here, so this will give you a more depictive picture. So this is NNF10, the 10 stocks on Nifty Next 50 index versus its benchmark index, and these are absolute returns, 3-year rolling returns from 2016 2016 onwards. So 16, 17, 18, the first point of calculation is at 2019. So you can see that 3-year rolling return absolute started out at about 72%, and then we had the crash in 2020, sorry. Then the 3-year rolling return reduced to 1%, and then it has built up again, and in the last 3 years it has built it back up to 82.9%. What you can see here is that the rolling returns of the strategy remained much higher than the rolling returns of the underlying index, and it never went into negative territory. The underlying index went into a 3-year rolling return of minus 15.9%, whereas the strategy was at plus 1.2%. So the inference to derive out of this is that you're getting superior returns in any 3-year given period, starting from March 19 and going every month ahead, and superior returns and never going into negative. Similarly, for Mi EverGreen, here we are seeing that for some period during the early part, the underlying benchmark returns were slightly better over a 3-year rolling period, but over post the pandemic, the 3-year rolling period of the EverGreen has been much superior than the underlying. And the underlying we have taken as CNX 200 index, whereas EverGreen also has a component of asset allocation. So that if we incorporate in this CNX 200 may make some difference here as well. This is 200 MI20, which is mid cap and small cap strategy, again versus the mid and small 400 index. And again the same dynamics is there, that outperformance over any 3-year given period and continuously so, and not going into any negative territory. And similarly for MI35, which is doing very, very well at plus 232.9% over a last 3-year period, and it has never seen a negative territory as well. So the idea behind showing you the rolling returns was to showcase that the longer the period of rolling returns, 5 years, 7 years, 10 years, the more confidence you will have on that kind of strategy, and the 1 year or 2 year sort of volatility that you see in performance will not impact you because your expectation will be set according to a longer term plan, and you will be able to stick to the strategy in a better way once you have that longer runway and longer expectation in mind. So with that, I'll end this this daily bite, and also want to remind that we are still running a special offer for all our long-term weekend investors from 2018, 19, 20 calendar year, 21 calendar year. Whoever has had a annual plan with us, we are offering the Mi EverGreen at a promotion. Use the promo code EverGreen20. So this is going to be there for some limited time, and we are also wanting that you send us your feedback on daily bytes on email or on Twitter, and we are continuously trying to find topics that may help you to quicken your learning curve, your knowledge base, and for us to make sure that each and every weekend investor is following the strategy or is executing the strategy without any gaps of what the information is, what the learning is, what the processes are, so on and so forth. So this is all I had for this daily bite. Thank you so much for watching, and I'll see you in another video. Bye.